Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through residual income valuation. Under residual income valuation, what we will specifically look at, so we'll be looking at residual income valuation. So what we'll look at under residual income include, for one, we will look at the definition. Then we will look at the application of the definition of residual income. So we'll look at an example there. Then we will move ahead and look at the concept of economic value added and market value added there. We will write the formulas for the two components. So in other words, we're saying it is going to be EVA and MVA, economic value added and market value added, right there. Then we will move ahead and look at an example that will be able to explain this. So we look at an example that computes the economic value added and the market value added. Then we'll look at the uses of residual income, valuation there. Once we've looked at the uses of residual income valuation, we will move ahead and look at the intrinsic value of common stock based on residual income. So the intrinsic value of common stock there. So we will be able to end this first topic review by looking at the intrinsic value of common stock, and then we can be able to now build on this concept by looking at lesson 2. Yeah. So we begin by looking at the definition of residual income. Definition. So we can say that residual income valuation is the fourth valuation tool that is gotten by getting, that's repeating myself, gotten by getting. We cannot say gotten by getting, we say is gotten by determining the net income and deducting a charge that is due to equity shareholders, or what you can be able to say common shareholders there. In traditional accounting sense, it is believed that once we have the sales value like that, with less cost of sales like that, so we have the sales value there, less cost of sales like that, we'll be able to achieve the gross profit like that. Once we have the gross profit with less expenses like that, then what we get? We get the net profit. Net profit there like that. So in traditional accounting sense, once an investor assesses the net profit component like that, then it is believed that the company is profitable. Taking it forward from the investments and financial analyst perspective, we try to provide a compensation that is due to common shareholders, because the common shareholders have actually provided funding to the organization, so they need to be compensated something. That is what you're saying, deduction or deducting a charge that is due to common shareholders there. So that means we need to deduct now what is due to common shareholders over here, and we can be able to see whether the value will either be a positive or a negative, like that. If we have a positive value, then we are saying that makes economic sense. After compensating the common shareholders like that, then we are saying we achieve a positive value. Then that indicates that the residual income is effective there. Now, if we achieve a negative value, it means that once we achieve the negative component of residual income, we are saying that it is not good for the firm, because after compensating the common shareholders right over here, then you are achieving a negative value. So in the truest sense, from the financial analyst perspective, or for the investments and financial analyst perspective, we need to compensate the shareholders, what we call an equity charge. This is an equity charge right there. So we can explain it further and say the charge due to common shareholders is called equity charge. It's called equity charge, which is gotten by it is gotten by cost of equity times value of equity. That's how we get the equity charge. We get the cost of equity, then we get multiplied by the value of equity there. Now, having looked at the definition right there, we now need to look at an example that will be able to demonstrate the residual income in perspective, or put the residual income in perspective there. So we have an example here. M company distributes fruit to grocery stores in large Kenyan cities. The book value of its assets is 1.4 billion, which is financed with 800 million in equity and 600 million in debt. Its before tax cost of debt is 3.33% and its marginal tax rate is 34%. EMS has a cost of equity of 12.3%. EMS abbreviated income statement is shown in the following figure. So we have the figure demonstrated to us there, where we can be able to see the EBIT is 142 million, the less interest expense, then you get the pre-tax income there of 122 million, less the income tax expense of 41,480, then you can be able to get the net income component of 80,520,000. Determine whether M is profitable by calculating the residual income and explaining its relationship to reported accounting income there. So what we need to do, we need to determine the formula for residual income. So we say solution there that residual income, RI, is given as net income less equity charge there. So the equity charge is gotten by cost of equity times the value of equity. Let's see if we've been given the net income. Yes, from that table there, we can be able to see that the net income is 80,520,000. Now we need to get the equity charge. The equity charge is just given by cost of equity, which we've done over here, times the value of equity. So let's see equity charge computation. There. So cost of equity is how much? we're saying the cost of equity is 12.3%. 12.3%. You can see we've already been given that value there. And the value of equity, or the equity component, so value of equity is 800 million, like that. So we say 800 million multiplied by 0.123, how much do we get? So we have 800 multiplied by 0.123. We have 98.4 million. So we have 98.4 million right there. Coming back to this formula here, we say RI is given as net income. The net income given to us there is 80,520,000. So it's 80,520,000, like that. Then you less 98,400,000. 98,400,000, like that. That's what you're saying. 98.4, 98,400,000, like that. How much do we get? 80,520 less 98,400,000. We get 17,880,000 there. Negative. So negative 17,880,000, like that. So we are saying that even if the company may have made a net profit or a net income of which is positive of 80,520,000, we are saying it may not be economically viable because we, after compensating the equity shareholders and the equity charge, we are saying that now we'll be able to get a negative value right there. So that means that in the traditional accounting sense, it seems profitable there. But after charging equity charge due to the equity shareholders, we receive a negative value there. So it may not be a good thing or a good idea, or it may not really be profitable in the truest sense based on the financial analyst side. So now we have done that example right there. Now let's look at economic value added and market value added right here. So this is what we're looking at right here. Now, the economic value added, or EVA, is given as, let's just first of all let's put that like that. So the EVA, or economic value added, is given as net operating profit after tax, like that. Then you less weighted average cost of capital, the product of weighted average cost of capital multiplied by the invested capital. Invested capital. There. Where EVA, no part, work, invested capital, economic value added. Value added. This is net operating profit after tax. Profit after tax. Then there is the weighted average cost of capital. Weighted average cost of capital, like that. Then this is the component of invested capital, where we are saying it is the net working capital. Net working capital plus net fixed assets. Plus net fixed assets. That is how we get the invested capital there. As well, to get the invested capital, we can also put a hyphen there and say, or, right there, or, put a hyphen there. We can be able to just get the long-term debt. Long-term debt. We add the component of long-term equity, or equity component. Equity capital, long-term debt capital plus the equity capital, long-term equity capital or the equity capital like that. So these are the two forms of how you can be able to get the invested capital there. Now, we look now at the market value added. So market value added. MVA is given as market value, then you less the invested capital component, invested capital component like that. Plain and simple. Now, to try and demonstrate this, let's look at an example. Now, we have V company reports a NOPAT or a net operating profit after tax of 2100, a weighted average cost of capital of 14.2%, and invested capital of 18,000. The market price of the firm's stock is 25 per share, and V has 800 shares outstanding. The market value of the firm's long-term debt is 4,000. Calculate V's EVA and MVA. Now, we start off by looking at the EVA solution. EVA or economic value added. We have NOPAT minus work times invested capital, like that. That is how we get the EVA. Let's try and identify if we've got all of the inputs. Do we have the net operating profit after tax? Yes, we do. It's 2100. So NOPAT 2100. The work, the weighted average cost of capital, I can see, yes, it's 14.2%, 0.142, and then invested capital. In this case, we have been given directly there, 18,000. Like that. Now, putting it all together, we have 2100 there, minus the component of work, 0.142, which you have there, then multiplied by 18,000, which you're saying is the invested capital there, multiplied by 18,000, like that. How much do we get? So we have 0.142 multiplied by 18,000. We get 2256. Then we have 2100 minus 2256, 456. 2100 minus 2256, then we have negative 456. Negative 456. You can put this in brackets to indicate a negative value there. That is the economic value added. Now, we look at the market value added. We said the market value added is just gotten by the market value, then you less the invested capital right there. So MVA, we have the market value less invested capital. So the market value is how much? The market value includes the component of debt. So the market value of the company, we need to get the equity component. So we are saying it's going to be market value is going to be 25 multiplied by 800. Yes, we can see the 800, which you're saying V has 800 shares outstanding. So 800. So we're getting the market value of equity. Then we add the component of debt to get the market value. So the market value of debt, we've been told, is 4,000. Yeah. So how much is the market value? So 25 multiplied by 800 is 20,000 plus 4,000. So it comes to 24,000. That. Now once we have that, we just get 24,000 minus the invested capital. We've already computed the invested, we've already been given, sorry, not computed. We've been given the invested capital as 18,000 there. So MVA is given as 24,000 minus 18,000 there. So 24,000 minus 18,000 looks like 6,000. Yes, it's 6,000. 6,000. Yeah, like that. So that is how you compute the economic value added and the market value added there. So having looked at that, we've done an example already over there. Now we need to move on and look at the uses of residual income valuation. The uses of residual income valuation. Residual income valuation. Uses of residual income. Now, residual income, remember what we defined at the beginning. We had said residual income, or RI, is given as the net income less the equity charge. Equity charge right there. And the equity charge is just equity charge. We had said is just the cost of equity times the value of equity. That's what you're saying. Trying to relate this with the uses of residual income, we are saying the first use is that RI, or in full, residual income, is used to evaluate executive compensation. Residual income is used in the investment industry to evaluate executive compensation. The second use of residual income is to try and evaluate managerial effectiveness or assess managerial effectiveness. Residual income is used to gauge managerial effectiveness. Like that. So those are the two major uses of residual income, like that. Now, having looked at the uses of residual income valuation, let's move on and look at the intrinsic value of common stock. The intrinsic value of common stock. Intrinsic value of common stock. Now, we had already defined what intrinsic value is. Intrinsic value is the value that you believe as an analyst the value of, say, a share like KCB should be at. So, for example, if the value of KCB based on the forces of demand and supply, which is yielded by the Nairobi Securities Exchange, is saying it is 42 shillings, that is the current market price. But if you use, say, for example, DDM, discounted dividend model over there, which you're saying is D naught 1 plus G over R minus G, and you determine that the value of KCB, for example, should be now at 43. Rather, let me just use a much more realistic example, maybe say 45, like that. So we said the rule of the thumb is if the current market price is greater than the intrinsic value is the one that you believe the value of the share should be, then it is overvalued. And you should not consider buying that security. But in this case, we are saying that the intrinsic value is greater than the current market price. So it is undervalued and you should go ahead and buy that security there. So in residual income, or applying that understanding to residual income, we are saying that we will be able to just come up with a formula, or we formulate a formula that is going to be applicable in trying to determine the intrinsic value there. So we are saying that residual income can also be gotten by getting the earnings like that. Then you less the product of the required return like that, and the book value of equity. Book value like that. Not necessarily book value of equity, just the book value component like that. That is how you get another form of getting the residual income. As well, we can also get the residual income if we have the required return on equity by trying to get the ROE multiplied by, rather, not multiplied by, we less, sorry about that, we less the required return, then we multiply by the book value. Book value like that, where ROE is residual, is return on equity, and R is the required return. Required return like that. So once we have those two, when we have the ROE, we have R, and we have the book value, we can also be able to get the residual income. Let's look at an example that can be able to highlight or apply that understanding there. Laura was assigned the task of forecasting the residual income for KCB company over the next 2 years. To accomplish this task, she assembled the information provided in the following figure. She assumed a required rate of return of 11%. Forecast KCB's residual income for 2009 and 2010. So the information provided there on that table should be able to assist us to compute the residual income there. So let's compute it. So we have the current market price. You can put it solution. Current market price is given as 24. There. We also have the current book value per share. Book value per share given to us there as 18. We also have the EPS, or earnings per share, 2008. We have rather 2009 and 2010 EPS for 2010. 2009 we have 2.05 and 2.22 like that. Dividend payout ratio is for 2009 and 2010. Dividend payout ratio 2010 is 0.65% like that. Rather, it's 65%. Sorry about that. It's 65%. Now, I've been told to forecast the residual income for 2009 and 2010. So, having been given that information there, we first of all draw in form of a table over here. We draw the beginning book value. So, we say beginning book value there. So we have 2009 2010. The beginning book value we can see here is 18 there. Once we've been given the book value there, we need to also include the earnings for 2010. So the EPS there for 2009 we have as 2.05. The beginning book value, you add the EPS for the current year and you less the dividends should give us the forecasted book value there. So we add the EPS and we less the dividends like that. The dividends, we have the dividend payout ratio of 65% and the 65% should be applied onto the earnings of that year. So if we can be able to have a small note over here and say 0.65, this is for 2009, 0.65 multiplied, that's 65%, multiplied by the earnings of that year, 2.05, how much do we get? And for 2010, we can be able to say we have the EPS right over here, 2.22. So it is 0.65 multiplied by 2.22 over here. So we'll just include the component of the dividends. Notice one thing, we do not have the beginning book value right over here. That is what we're trying to determine by getting the dividends over here. So we get 18 plus 2.05, then you less a value over here so that we can be able to get the forecasted book value right here. So how much is that value then? The value will be, so it's 0.65 multiplied by 2.05. There we have 1.33 there. And these dividends should be less as well. 0.65 multiplied by 2.22, we have 1.44. And that should be less. So here we have the forecasted book value. There like that. So we can do it, we just draw a line like that. 18 plus 2.05 minus 1.33, how much do we get? 18 plus 2.05 minus 1.33, how much do we get? 18.72. 18.72. This forecasted book value is going to be applied onto the next year there. So this one over here comes to that. So we can put that in form of an asterisk there. Then we put it right above here. So 18.72. Now 18.72, we add 2.22 and less 1.44. How much do we get as the forecasted book value? So we have 18.72. We add 2.22 with that, and then we less 1.44. 19.5. 19.5. You still put an asterisk there. That is the forecasted book value. Now to try and get the residual income, we must get, based on this formula here, remember the residual income is got to the earnings minus required return times the book value there. In this case, we do not have the ROE, which is what we are saying, the return on equity. So this is the formula we should go by over here. The earnings less the product of the required return and the book value. Yes. So now we need to get this equity charge component over here. This over here is the equity charge. So less the equity charge, less equity charge there. The required return has been given to us in the question there. We have the required return of, I can see the required return was given to us as 11%. Yes. So we just come over here. We can have a side note over here. For 2009, the equity charge is going to be 0.11, which we're saying is the required return right over here. And then we multiply by the book value. Which book value are we going to use? We are not going to use this book value over here, the forecasted book value. We will use the beginning book value right there, which you're saying is 18 there. So how much do we get? So we multiply by 18 there. That's for 2009. For 2010, we can say it is as follows. It is 0.11, that remains constant, multiplied by now this component. Now, since it comes over here, this is going to be the current or the beginning book value times 18.72 right there. So how much do we get in both cases? 18. We have 1.98 there, and multiplied by 18.72. We have 2.06 there. So we come and slot those values directly here under the equity charge. 1.98, like that, we are lessing it, and 2.06, like that. We are lessing that as well. So we can come up over here and get the residual income. So RI, which you're saying is the residual income, is just the net income or the earnings less the equity charge, which you're saying is the required return times book value. There. So which will be as follows: the earnings, which would be similar to the EPS right there. Rather, I had put a negative value on that. I don't know whether the answer will be the same. Apologies for that. You can see it's the dividends which are supposed to be less. Yeah, actually it's the dividends. It's okay. Sorry about that. It's actually okay. So I was thinking it was this. We had minus that, but it's actually in the same line there. We are actually correct about that. So the EPS estimate right now, I was thinking that is the value. So the EPS is this value here. Those two values right there, those are the ones that represent the EPS. So the earnings, which you're saying is 2.05 minus, this is for 2009, RI 2009 is 2.05 minus the product of the required return times the book value there. Equity charge, which you're saying is 1.98 there, yes. So 1.98, that's for 2009. RI to 2010 is given as, we are saying this is the earnings or the EPS, which you're saying is 2.22 minus now the 2.06. What do we have there? So we have 2.05 minus 1.98, 0.07. That is the residual income for 2009. For 2010, we have 2.22, we minus 2.06, we have 0.16, like that. So that is how we can be able to compute the residual income, like that. And this concludes our first lesson for residual income. We hope that you'll be able to join us in our next lesson, where we will build on these concepts right over here, like that. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.